Everyone, and welcome if you are just joining us, and welcome back if you're in the last session. Good to see you all. We're about to get started and have a chat with Scott Baldwin, the CEO of Money3. This is a market-leading consumer and commercial finance company with more than 20 years of experience in Australia and New Zealand. During that time, it's funded more than $1.5 billion of vehicle and personal loans. It's dominated the used vehicle finance market, and this year expanding its product offering into new and commercial vehicle lending. So that's a total market opportunity exceeding sort of $40 billion across Australia and New Zealand. Well on its way already to originating $500 million worth of new loans. It's recently completed a couple of pivotal acquisitions. There's certainly a lot to talk about. I'm going to hand over in just a moment to Scott Baldwin, the CEO, but just a reminder, of course, if you've got questions through the presentation, you can drop them down into the Q&A box at the bottom of your screen, and we'll get through as many as we possibly can at the end of Scott's presentation. So Scott, over to you.
Thanks, Kylie. Appreciate the opportunity to present to people today. Hopefully everyone can see the presentation. I'll just step through that and take you through the business. Money3, as you said, is a consumer and commercial, principally automotive finance company. We've added the commercial arm only in the last couple of months with the acquisition of Automotive Financial Services, which has, similar to our Go Car Finance business we acquired a couple of years ago now, come in as an additional product and has worked quite well so far with the business. Our target market is everyone looking for a used car, growing into the new car and growing into that commercial segment as well. They're sort of new arms to our businesses as well. One of the key strengths of Money3 is our ability to interface our software with our introduction partners, whether they be dealers, brokers, or even a variety of websites that acquire people's details as they're looking to apply for a car loan. One of the things that we think makes Money3 stand out from many of our peers is our very strong customer care culture and processes around giving people flexibility with the repayment of their loan. Just talking a little bit about the market to give those new investors an understanding of the size. I mean, there's 24 million vehicles in Australia and New Zealand. And where there's a little bit better data in Australia, I mean, we see over 3 million of those 20 million changing hands every year in Australia, which means we basically have 3 million opportunities to provide finance with a lot of industry data saying that around 90% of people borrow money for the acquisition of a vehicle, which is a great opportunity. In spite of COVID, you'll note that the market continues to grow. While there's 20 million vehicles today, that this is a growing trend in both countries where we have somewhat poor public transports because the countries are quite spread out. So vehicle ownership in both countries is quite high. And we're expecting to see the trend of people resisting the use of public transport, preferring their own vehicle as a result of the pandemic. So we've certainly seen very strong demand in both countries for people, particularly after the new year, looking to purchase a vehicle. So many of you would have read or seen that there has been a shortage of vehicles, which has driven up prices of used cars a little bit. We're starting to see that abate, albeit small, but we're starting to see that turn where supply is starting to return, particularly in New Zealand, where shipments are returning from Japan, where a lot of their used vehicles come from on a more regular basis now, which is great for our dealers starting to get stock. Just moving on. So this is the three business units of Money3. For those that have followed the story for a number of years, you'll note that Money3 is the core brand and the original brand of the business that provides non-conforming car loans in Australia. We recently acquired in January of this year Automotive Financial Services, which gives Money3 a product and a product in that near prime segment. So similar to a better credit quality in the overall portfolio mix. Delighted to say that that business was not originating loans when we acquired it. As a result of COVID, it had stopped. We started lending again. It's now riding north of $3 million a month, and those relationships start to come back, and that business unit as we put it into the Money3 distribution is going really well. Go Car Finance, an acquisition that we did over 2 years ago now, continues to go from strength to strength. It's well on its way towards having a $150 million loan book by June 30. Cash flows have been really strong and demand is very much picking up there as vehicles start to return. So that's the three product segments across Money3. All of them are provided through our three distribution channels of dealers, brokers, and a very strong online presence, which is what's driving that returning customer metric that you'll see throughout the slides. Just going on about that, our distribution is principally three arms to all three businesses now. A direct business, which is principally online or through direct marketing to customers to return to us for the acquisition of their second or third car. Money3 really has a strength in that, and the two acquisitions we've made, that's something that we see our ability to bring to both of those to lift their distribution of either the near prime AFS product or the full suite that we have in New Zealand under Go Car Finance. Almost 40% of our business now is coming through that channel, which is a great uplift for the Money3 brand, but certainly driving the growth in New Zealand in particular too. So you've got your very strong dealer distribution and a growing direct presence as well. In terms of distribution in New Zealand, fledgling broker arm. In Australia, a broker continues to dominate, but a very strong direct to company distribution as well through websites. Product focus. As a result of the acquisition, we now have a very strong presence in the provision of finance for a used vehicle, growing presence and growing distribution in new vehicle finance, and also a very small arm in commercial lending. The reason why a lot of our partners choose to use us is we have a very strong technology back end. We spend a lot of time integrating our credit process with our partners' front-end systems. Typically, they use a product like Salesforce to capture all that client data, and the ability to seamlessly move that between two companies has really it's given customers what they keep telling us, a very positive experience. Our Net Promoter Score continues to be north of 70, and the feedback is that we've made it very simple for people to apply for a car loan. They often can do the whole process simply from their mobile phone without having to go to other devices. And then as other technologies that let you sign things digitally come into the process, really you can apply, sign, and do everything from your mobile phone now. And that's our aim, is to continue to build out that process and that integration between where the customer is looking for their vehicle to the settlement of the loan. So why we think our future looks bright and why we think investors should consider Money3 is we have a very strong executive team. Now, with the two acquisitions, the founders have agreed to stay on and work in the business. In fact, they are both top 20 shareholders in Money3 today. So not only have they allowed us to buy their business, but they believe in the story of where we're going. They've taken the majority of that as equity and stayed on to help us grow the business. So we do have quite a wide team of industry professionals now that understand broking, dealer distribution, as well as that growing technology and digital side to our business as well. And I'm delighted that they're all contributing in their unique specialty that we're then able to cross-pollinate that into our other brands. So, Money3's direct business has really helped Go Car lift their volume, for example. So, which I think that provides a lot of a strong alignment for shareholders. The fact that the majority executive team are all reasonable shareholders in the group. We have a very strong funding position coming into 21 as a result of the facility, $250 million facility that was approved by Credit Suisse. We continue to draw down on that every month now, and that is working very well. The big benefit for shareholders is in June of this year, where Credit Suisse will replace the funding that Fortress has in place, and all of that, excuse me, because there's around a 4% improvement in our cost of funding by going from Fortress to Credit Suisse. So shareholders will very much benefit that from the 1st of July next year, and it will provide a significant uplift in our bottom line. The Westpac facility that is in place today continues to be drawn every time we write a loan through our automotive financial services business, and that's not to mention that we have a bank in New Zealand, Bank of New Zealand, BNZ Bank, providing us funding in New Zealand, and another bank there looking to set up an additional warehouse for us to continue to grow the business there. Really to focus on the technology, it's a final piece of why I think our business is very strong. We do have integration into hundreds of business partners around the country. Those processes take a long time to develop, and is the reason why we see growing number of applications across our business. We are now receiving over 250,000 on average annual applications for finance, and growing every day as people start to get confidence in both countries to borrow again. So this is our first half financials. Many investors will have already read this. So I'll just talk about some of the feedback we got from other investors through our round of presentations. I mean, we put out a forecast for $36 million for the full year, and I know that some people said that was lower than expectation. Now, part of that is because of some non-recurring costs that we have in the business as a result of the Fortress finance now being repaid 6 months early. So some of the setup costs have to amortise 6 months quicker than they did. There's also a couple of one-off costs that we will bear in this 6-month period now in the second half that we wouldn't normally. And I think the other bit too, which is every day improving, we've seen government change the amount of JobKeeper payment, increasing that to about $307 a week. We've also seen January and February's results now that we're very confident that the guidance we've given is achievable or will be exceeded as a result of continuing strong cash flows and still bad debts at the lower end of our guidance. So what I'm trying to say is that there are a number of one-off costs that have driven to that $36 million forecast, but we have had a lot of positive momentum coming into the first 2 months of the year too that should give investors confidence that we're well on the track to achieve that. I'll just move on to the next. The outlook for the year, we've talked a little bit about this in terms of the forecast. Our target loan book is probably at the top end of what we expect to do, mainly off the back of some very strong cash flows. We certainly continue to see consumers concerned a little bit about their vehicle, and what they're saying is we don't want to lose our assets, so we'd like to pay a little bit additional towards the loan, which has been very positively received by the group and will continue to drive above expectation from a revenue, lower bad debts, and this year will be a very strong result. I'll hand back to you now if there's any questions.
Great, thanks, Scott. Again, everybody, just a reminder, you can pop your questions in that Q&A box at the end, and we've got some coming through already. I might just start if we can get a little bit more detail from you around the impact of COVID. Obviously, you're talking there about your bad debts, your expectation around bad debts coming in, lower than what you thought they would be. Do you think that impact of COVID has completely washed through the business now, or are you still kind of, do you have any concerns, for example, when JobKeeper rolls off?
I think our concerns go down every day. I mean, we've seen a lot of government stimulus and a lot of government projects. So if you look at what's come out in today's paper with very low unemployment, the JobKeeper program has lifted. It's now above $300 a week. So even as we start to return to a post-COVID world, consumers that are looking for work are now getting more money than they were a year ago. So all of those things are actually really positive for us. We've seen strong cash flows. we've seen government support that is going to support people that do lose their job. And we've also seen a lot of those people pay down their loans to be in advance through the period where there was excess cash coming into the system through stimulus, that many consumers are in a really good spot in our portfolio. So every day, a year ago, if we had a crystal ball, we did take that $10 million of impairment provision, preparing for the worst, and it's actually turned out far better than we expected. Now, while we yet to see what the end of the month looks like as it starts to roll off, everything is suggesting to us that it's going to be somewhat a soft landing in terms of bad debts as the economy recovers, jobs stay strong, and support from the government continues to be quite strong for consumers.
Yeah, okay. So a follow-up question to that's just come through from Chris about, what provision have you included in the second half for a normalisation post JobKeeper rolling off, and do you think it could prove conservative?
Look, no doubt it is. So that $10 million of provision, we've agreed with our auditors that we will look at that in June after we've had a couple of months of roll-off, and I expect some of that will be released in this year's financials, and that's not factored into our $36 million forecast. So we're growing confidence with what we're seeing at this point in time. And
so how are you thinking about your dividend policy at the moment, given the last half, and you're obviously in a very different position and being very conservative?
Oh, look, the board have put that statement out that the next dividend will be at least 6 cents, and they'll look to see what so 9 cents for the full year, 3 cents about to be paid in the next couple of weeks, and a 6 cent dividend at the end of the year. So at least a 9 cent dividend for the full year. And I'm sure that the board will look at that in August when our full year results are released, with a view to returning to more normal levels of dividend. And if you look to our past, we've generally been paying 10 cents a year over the last 2 or 3 years.
Okay, cool. Lots of questions on the numbers today, Scott. Sorry about this. I've got another one. Can you run us through what a $1 billion loan book would look like from a P&L point of view?
Absolutely. We've been talking about that for some time, and I know that there's a lot of analysts out there building models of the business, and we're riding around $30 million a month. That's increasing. Any of those analysts, as they've moved that sort of to 35, 40, will see that in a couple of years' time, that we only need mild growth from where we are today and a couple of years, and we'll hit that $1 billion loan book. We certainly think in the market, as we broaden our appetite, that there is some gross yield reduction, but we don't think that's beyond a 25% gross yield. So a $1 billion loan book is a business that should have a revenue of around $250 million. And there's some positive movement in terms of our OPEX. And without giving everyone a guidance of what our NPAT will look like in 2 years, everyone can look from our margins. They're not going to have material movement. If anything, we're expecting slight improvement on those as cost of funding continues to improve. And as the book grows, the OPEX doesn't need to grow in line with that, outside of continual investments we'd like to make in technology. So we think when we hit there that the business is well on track to be around that 20% return on the equity within the business when we hit that number.
Okay. We've got questions from Chris and Max on costs, so I might sort of roll them together and get you to take them both as one. Firstly, are you able to quantify the level of non-recurring costs included in the $36 million guidance? And secondly, related, can you provide some further details on the one-off costs that will be incurred in the second half?
So it's around $2 million, and those one-off costs are related to the early amortisation of the Fortress debt. There's some acquisition costs that come out of the Holden book that we bought. We acquired $24 million worth of receivables from General Motors Holden that had some one-off costs, and also the automotive financial services business, some legal fees and other costs that come through there. So there's really sort of 4 buckets of one-off costs that occur and that's them in the second half.
Okay. I think it would be remiss not to have this conversation given how hot the buy now, pay later sector has been, and particularly, when we've seen this week CBA coming into the market. I think there are sort of some people playing around the fringes in BNPL in auto financing. Is that something that you're looking at seriously? And do you get a sense that because that seems to be the way credit is going, that it's inevitable that we will be buying now, paying later on cars?
Sort of a loan is, drive the car now, pay for it over time. It's
Yeah.
you could say we offer a drive now, pay later product today, and people generally pay for that over 36 months. I guess the larger loan. The larger loan values, I don't see playing as well to that small ticket item over a 6-week period. I mean, the whole reason why car loan tends to be a 3 to 5 year term is because of the amount that people borrow. But we certainly see a significant change in the environment of lending money. The big banks are not going to be the dominant players moving forward. I don't feel they are. We can see from, consumers can see that Westpac is retreating from the space. Similar to what we saw when ANZ did that a few years ago, it creates massive disruption and it creates opportunity for people like Money3 and our peers to go into all of those dealerships and say, now that the bank is not providing the service, would you give us a go? And the bank may come back again, but some of those relationships will stick and they will stay with us. And, one of the great things that we like about that is some of those people that have good, robust client acquisition software, all of a sudden say, yes, we'll consider doing that with you. And once that integration happens, it becomes very seamless for them to push an application for finance through to the Money3 group. And we tend to keep them and build on that from that starting point. And I expect that things like this Westpac trade that's happening at the moment to sell their automotive finance business is going to be a huge positive for the whole industry, because if you look at all of the big players, I'm sure they don't finance anywhere near the $4 billion that Westpac's financing in vehicles a year. So you only need a little bit of that to fall off, and it's I expect to see significant growth in our business as a result of that, let alone growing market and our ability to continue to take share from our peers.
So I guess related to that, if you look at the impact that fintechs have had on the big four in mortgages, you can now get a home loan online without downloading forms and faxing things. It's like the world has sort of caught up to the way people live. If you look at that disruption that's taking place in the mortgage space and you look at the people who are playing in there, do you consider that sort of a threat to you, that they will then, bring that into the vehicle space? Or do you see that as, essentially growing the pie, and I suppose, you're in with them, taking market share away from the traditional players?
I think that's well underway. I mean, anybody that's providing finance that doesn't have, a ubiquitous approach from application through the settlement is not going to get volume in this space. Our investment in technology has ramped up significantly, as have many of those other fintech players that we compete with. And it's about, while I call it integration with partners, I mean, it very much is about, as you say, allowing people to walk into a dealership, see a vehicle they like, start typing on their mobile phone their name, and having the services that we provide to fill in things like their address, so that they're not typing all that in, that those services make it very easy for a customer to apply for the loan. I think the great thing about our model is we're out there seeing all of these variety of introduction partners invest differently and try and solve that problem differently. And we sit just behind them, capturing all that data off them through an API that comes into our credit algorithm for quick processing. And I think the thing that's going to change the industry the most is the person that can provide the fastest pre-approval or fastest approval for the loan, because consumers' expectations are, I'm walking around the dealership and I'm going to go and have a coffee. I want to know that I'm pre-approved in the next hour or so. Ideally, so when the weekend comes, I'm driving in my new car. We very much see that trend and expectation that lenders will give a very quick response. Has improved significantly. Hence why all of our processes are designed around giving an answer in a couple of hours.
Yeah. So you talked about, your growth strategy and not necessarily needing to, increase OPEX in line with your loan book and your number of customers. But do you have a sense of, the growth in cost that will come to you because you are going to need to keep investing in technology to stay ahead of the curve?
Look, every year we look at what is the right investment to make, and that number looks like about $1 to $2 million. And that tends to be an ongoing program focused in different areas of our business of improving technology. And I would say when we look into FY22, we certainly see investors should start to see the technology line continue to grow, but it will drive a flattening of the human resource or labour line within our business, because every day that the use of technology is meaning that our staff are able to process more loans than they did a year ago. If you think the journey of Money3 has been sort of a 20% improvement of a credit analyst's number of loans that they can process year on year over the last 4 or 5 years, and that what's lifting that productivity in our business has been the greater adoption of technology to fill forms in, to reduce the amount of things that people type, to improve the quality of the data because you're going to third-party databases for things like addresses that they're not being typed in, which is reducing errors, creating more mineable data to know who to market to, and improving the credit analyst's speed to process a loan.
There's a really interesting question that's just come in about the number of your originations that are now coming from direct consumer relationships, asking, do you think long-term having a greater portion of those direct relationships will protect you from, for instance, price-led competition if you were just relying on that sort of broker and dealer channel?
You are spot on. There's less margin pressure from a happy customer returning for a second or third vehicle than there is from a broker introduced loan. And the pricing pressure is not always to the consumer's benefit, but they're certainly growing as the Royal Commission happened, where brokers receive their remuneration from is naturally changing as a result of that. And a lot of that pressure is coming back to lenders like us to fill that gap in paying for those distribution networks. So I do think it makes us a more stable and secure business compared to many of our peers that generate 100% of their leads from a paid-for source, whether it be a broker or online advertising, for example. Certainly some of the ones that we've seen have very strong growth also have very large marketing spends, which doesn't create the stickiness or loyalty that we're trying to get from a customer. Investors would see that our marketing spend compared to many of our peers is actually quite low. And that's because we tend to focus more on campaigns to customers that we know that are looking for the service rather than just spraying our advertising dollar out. And it works very well. One of the big core strengths of Money3 over many of our peers is we already have 500,000 people that have taken a loan from us. We already have 30 years of experience if you look at that recent acquisition of AFS, and all of those customers try and keep in regular contact with them, because it's not just about the provision of the vehicle, it's to follow up at the end to make sure that they're servicing and repairing their car, making an offer that if they need to put some maintenance on their car, that we continue to fund that too, and we keep the relationship going until they want to buy a new vehicle or another used vehicle.
Yeah, and you just keep that life cycle going. Scott Baldwin, fascinating discussion. Great to talk to you. We do have to leave it there and move on to the next presentation. Everybody, if you thank you very much for being on this one. If you do have any further questions that we didn't get to, you can just drop the guys at NWR a note and they will sort that out for you. But Scott, appreciate your time.
No, thanks very much.